So guys, when it comes to dividend investing, there are a lot of bad decisions you could potentially make. Trust me, I know because I've made many of them myself, and in this video, I'm going to tell you about the 3 biggest dividend investing mistakes that I've made in the handful of years I've been doing this. But before we get to that, guys, I want to hear from you. Leave me a comment below and let me know what have been some of the biggest mistakes that you've made in your investing journey so far. I'd be curious to know. Now guys, this first mistake happened with a company that I'm sure many of us are familiar with. This one is Intel, the semiconductor manufacturing giant that over these last handful of years has fallen on hard times and has really struggled to turn things around. So we can see I first started investing in this company toward the end of summer 2021 at what now looks like a ridiculous share price in the low 50s, and it looks like I was buying pretty regularly at these high prices. Now, as I'm sure you can imagine, when I first invested in Intel, it seemed like a solid choice. After all, it's one of the most recognizable names in technology. It had a long history of innovation and for a long time was the undisputed top dog in the industry. Now, I was familiar with the company because their chips were in pretty much every computer I'd ever used, but that basic familiarity gave me what turned out to be this false sense of understanding of the business, and I thought that I understood it well enough to put money into it. Now, Intel both designs and manufactures its chips, which I believed gave it a competitive advantage, but these days I think the opposite is true. Generally speaking, it seems that businesses tend to perform better when they're able to focus on just one thing, and this certainly seems to be the case with the other semiconductor companies like Nvidia, AMD, and TSMC, who are focused on either designing chips or manufacturing them, not both. Now with that, guys, I'd be lying if I said that the dividend yield at the time also wasn't a major draw for me when it came to investing in Intel. At that point in my investing journey, which would have been like a year into it, so I was very, very new to the game still, I put a lot of emphasis on the yield, probably more than I should have. And Intel's yield at the time I bought it was somewhere around 3 to 4%, I think, and at one point it had reached over 5%, so it really got up there, which was solid in its own right. But this yield was killer compared to some of the other technology companies like Apple or Microsoft, who both have yields like less than 1%. With that said though, in hindsight, I didn't fully understand the myriad of challenges that Intel was facing at the time, which would lead them to eventually cut the dividend, and then after that, soon after that, completely eliminate the dividend. Intel's lunch was being eaten by the likes of AMD and Nvidia, both of which were designing better products, and at the same time, Intel couldn't seem to get things right on the manufacturing side either and was losing to TSMC. Now, these issues weren't entirely secret, but as someone who didn't fully understand the industry or the business as well as he should have, I just didn't dig deep enough into these issues. And the thing is, if I would have just looked at the financials, I would have seen the writing on the wall. And these days, things in that department just continue to get worse for Intel. Taking a look at the company's financials over here on Snapstock, which you can get access to when you become a member of the investment club. And if you want to learn more about that, there's a link to it in the description and in the pinned comment of the video. But like I said, guys, the writing has been on the wall for Intel. Leading up to 2021, things were still looking pretty good as far as the revenue goes, but after that, it really just started falling off a cliff. And the same is true when we look at the earnings per share. After 2021, things really started to go downhill to the point where in the trailing 12 months, they actually were losing money. And these days, this company's not even free cash flow positive, and this has been going on for the last couple of years now. And as far as the dividend goes, the company eliminating the dividend in hindsight is not all too surprising. All you would have needed to do was look at the free cash flow per share, and as soon as it dipped below 0, that's a pretty big red flag. But anyway, looking at the margins, these have been deteriorating as well. We can see that the gross profit margin really just consistently goes down over the last 10 years. And the same is true here with the net profit margin. It was looking pretty good up until 2018, but from there, guys, it really went downhill. And then, yes, once again, we're seeing a similar trend here in the free cash flow margin. None of it looks good. And then while all of this is going on, the company continues to take on a lot more debt. We can see the net debt really goes up, while at the same time, the company's interest coverage goes down. So while they're adding debt to the balance sheet, they're less able to cover that debt, which is not a great sign. And then if we scroll back up looking at the share price performance, we can see that the share price has pretty much followed the same trend as the financials. April 15, 2021 was where the share price peaked at almost $60 per share. And from there, it was nothing but downhill going into 2023, where it saw a low of looks like about $25 per share. So it was basically cut in half, more than cut in half actually. But then from here, it shot back up yet again, and it looks like it peaked going into 2024 at about the mid 40s. And somewhere in here is when I sold my position. We'll take a look at that in just a moment. But since then, guys, it's come back down to all new lows of about $20 per share. And over over the last 5 years, the share price is down 66%. Now jumping over here and taking a look at my sold Intel position using my dividend portfolio tracking spreadsheet, which you can start using for free. There is a link to download this spreadsheet in the description of the video. And what we're looking at here is my sold positions page, which is pretty self-explanatory. Anytime I sell out of a position, I put some of the details in right here. We can see that I sold my Intel position on November 20th, 2023. This was, I think, this was after they cut the dividend, but before they eliminated the dividend. And at the time, I had 63 shares at an average cost of $44.29, and I was pretty break even upon selling. I sold at $44.46, and I'm so glad I did, because as we saw, the share price is now less than half of that, and I made it out unscathed, just barely, guys. I was barely in the green just looking at the share price returns, up 0.4%, and on a total return basis, including dividends, I only made it out with a 4.5% total return, which is not good at all. Now today, in hindsight, it seems like a no-brainer to avoid this company at all costs, since Intel just looks like a walking red flag. But this was a lesson that I had to learn the hard way, as most are. My decision to invest in Intel was based pretty much solely on surface level information and an overemphasis on the dividend stats. And even though I did make money on the position, just purely out of luck, investing in it was still a mistake for me. Like I said though, this taught me a couple of very important lessons. The first of which is if you don't understand the business you're investing in, you shouldn't be investing in it. And also, the second one, there's more to investing in dividend stocks than just looking at the dividend yield. These are two very important lessons. Now, my second mistake, guys, occurred with another very recognizable company. This one is 3M, which was one of the first dividend stocks I ever bought, and until recently was an iconic dividend king. Prior to cutting their dividend in 2024, 3M had been growing that thing for more than 60 years. And when I first started investing, I thought the Dividend King label meant that these stocks were like indestructible. You know, I figured that if they've been able to grow their dividends for 50 consecutive years and they've got this thing down to a science, there's nothing that can break them at this point. But in hindsight, I was basing 3M's future on its past. You know, I thought that the company would perpetually be this steady and stable dividend stock that, while slow growing, would still be reliable, and it just turned out not to be the case. 3M had found itself in the middle of a couple pretty big lawsuits, which included earplugs that allegedly caused hearing damage for military personnel, and PFAS contamination, also known as forever chemicals that are linked to environmental and health issues. But at any rate, these lawsuits created uncertainty and potentially massive liabilities for the company, which over the last few years really helped push the share price down. And following the spinoff of its healthcare division in 2024, 3M did eventually cut the dividend by about 50%. Fortunately, the dividend cut happened about a year after I sold my shares, but I still ended up taking a pretty big loss on this investment, as we can see here. I had about 12 shares of 3M. My average cost per share was very high at $165.43, and I sold when the share price was right at around $111 or so, and from here it got down, I think, below $90 per share. I don't remember if it went below $80 from there, but I definitely know it went sub $100. So basically, I got out while I could, and we can see that it has since recovered a little bit. Now the share price is sitting at about $130 per share, but this has been my biggest loser so far. In terms of share price, I was down 33% on this position upon selling. Not great, guys, and the total return wasn't much better either. I took a 27% loss, including dividends. And for me, the big lesson learned from this investment was that dividend kings aren't invincible, and you shouldn't assume that a stock will be a good investment just because it's a dividend king. Even if a company has a long-standing history of stability and dependability, you need to look at the big picture to determine whether or not that can continue. Now, guys, while the first two mistakes that we've talked about happened as a result of things I did, actions that I took, this third mistake is the opposite and happened as a result of my inability to take action. This third mistake, guys, tells the story of the one that got away. This one is my great white whale. We all have one of these, but in my case, it is Rollins, ticker symbol ROL, which is the world's largest pest control company, and I think there is so much to love about it. Not only is the great majority of their revenue recurring, but this is a pretty simple business to understand. Plus, it's boring, which is a good thing in investing and likely to be needed well into the future, considering we'll still have ants, spiders, termites, and other critters who get into places they shouldn't. And as far as the financials go, this company is just a growth monster, guys. In all departments, revenue, earnings per share, and free cash flow per share, we can see that everything is up and to the right at double-digit rates. The 5-year revenue growth rate is over 11%. The earnings per share 5-year CAGR is 21.4%, and the free cash flow CAGR in the same time period is 15.2%. All very solid. And with that, if we scroll down looking at the profitability, the gross margin's pretty steady, sitting around 50% over the last decade. That's a good sign. The net income margin, or the net profit margin, is actually increasing over the years. So on the bottom line, this company is becoming more profitable over time, which is a great sign. And the same is true here with the free cash flow margin. We can see this steadily ticking up and to the right. And then if we scroll down, taking a look at the debt situation, we can see that in 2023, this company's debt jumped up quite a bit, but it's still nothing to be too concerned about. The net debt to free cash flow is only 1.4, so it's nothing out of hand, which means that if they dedicated all of their free cash flow to paying off the debt, it would only take them basically a year and a half to do so. That's not bad at all. And if we scroll down looking at the dividend stats, guys, this is where the magic happens. If we look at the starting yield, it's only 1.3%, but this is a little bit above the 5-year average of 1.2%, so that's a good sign. But the dividend growth has just been phenomenal, guys. Over 10 years of dividend growth, and the 5-year CAGR is 17%, so that's looking really great. And if we scroll down just a little bit more, looking at the returns on invested capital, this has been very solid over the last decade. At the lowest over these last 10 years, in 2020, the return on invested capital was like 22%. So if that's the worst it's going to get for this company, that's a very promising sign and looks poised to just continue delivering returns for shareholders. So like I said, there's a lot to love about this company. It looks like it has all the makings to be a really great investment, and I totally missed the boat on this one. I don't remember exactly when I first started talking about this stock or when it came onto my radar. It could be somewhere right around here, but I remember the share price was somewhere in the low 30s, like around $32, $33 per share. But instead of starting a position in this company at what now in hindsight was a very respectable price, I hesitated and I kept thinking it's too expensive. I'll just wait for it to come down some more. But here's the crazy thing about that, or the dumb thing, I think, is I wasn't waiting for this crazy pullback. It's not like I wanted Rollins to go from, $32, $33 per share down to like 22 or 23. I just wanted it to go down to maybe 30, which, like I said, guys, in hindsight, that's ridiculous because the share price just continued to climb from there. And at its recent peak was about $51 per share. It's come down a little bit. Now it's sitting in the mid 40s. My hesitation at the time came down to just wanting to buy Rollins at the perfect price. I wanted everything to line up perfectly, but in doing so, I missed out on a great opportunity. And the lesson here, guys, is this. When you're presented with a high-quality business that checks all the boxes, a no-brainer, don't overthink it. Sometimes waiting for that perfect opportunity means missing out entirely. Also, referring back to my other mistakes, don't forget to stay within your circle of competence. Don't buy a stock just because of its dividend yield, and also avoid the stocks that I'm telling you about in this next video right over here. In this one, you'll learn about 3 dividend stocks that many investors like to buy, but truth be told, they're terrible investments and you should avoid them at all costs. So click right over here to learn about those, and I'll see you in the next one.